How do you swap rates in your forex carry trading strategy? I couldn't imagine a better person to have here explaining this stuff. He's explained it to me several times, and I know so many people, new entrants into the forex community. One of the big things, Paul, is always why, if I'm long or short this forex pair, why did I see a little credit or debit in my account last night? Or why is your platform telling me about the swap bid and swap offer? I only know about the prices bid and offer, and that just tells me where I can buy and sell. What does this thing mean? And I figure we start with the prime example of the tastyfx platform here. How do swap rates work? Let's have you take us through it.
Sure. So very loosely, it's basically a interest rate differential between the two currencies and the currency pair that you're trading. Your swap bid is if you're going to be short overnight, and your swap ask is going to be if you're long overnight. When I say overnight, when overnight starts is that if you hold a position through 5 p.m. Eastern Time, 4 p.m. Central. So that's the key. It does include our overnight admin fees in this. It's baked into the swap bid and swap ask that you see on the platform.
What is that admin fee? Because that's a sneaky thing that people might be like, oh, well, you know, I have been to a casino or two in my time, and that VIG can be pretty heavy, makes it really hard. But what is the admin fee at tastyfx?
Yeah, it's 0.5% per annum.
Okay.
So if you take 0.5%, I think we have it on our website somewhere where you can actually where it breaks out the math fully for you. But you basically take 0.5% of the 4 p.m. Central mid price of the currency pair. It works out to basically like 1/10 of a pip, I think, if I do the math off the top of my head. But it's very small. Like
0.5% per year. And so, like, if I'm looking at it, I just want to hold this for one night. You're talking about 1/365 times that 0.5%. Or if there's an interest rate differential between the U.S. and Swiss National Bank of 4%. If you were going to hold it for a whole year, that difference would be like 3.5%. Okay, gotcha. And you can see here with some of them, like pound, I believe the U.S. has, we're at like 4.35%. We're in that 4.25% to 4.5%. And I believe the UK is solidly 4.25. And so that's one of those scenarios where it's actually long or short. It's a small overnight debit to your account. But obviously, you look at the dollar yen or even euro dollar at this point, and the U.S. having higher rates is leading to positive carry in the U.S. direction for these pairs, right?
Yep, absolutely. And that's what you see across the board. And kind of how you can tell that. If you look at Euro USD kind of on our PowerPoint slide here, the swap bid, meaning you're short Euro USD, you're long dollars, you're short euros. That is where you get the positive carry. Obviously, around the flip side of things, you're going to actually pay to hold that position overnight because the dollar has a higher interest rate than the euro.
Awesome. Let's take a look at an example a little bit closer, because this is one that's been interesting to a lot of people really for the last 3 years. At this point, it's more than 3 years, because Japan's interest rates have been near zero for, I believe, more than a decade at this point, although they are now up to positive 50 basis points. They were negative for a stretch there. The U.S. still having rates north of 4%, and Japan still having rates south of 1%. Still a positive carry in that U.S. dollar direction. When you're talking about, I took this yesterday, and you're talking about a little over a point of positive carry on an average day around right now. It's June 4th. This can be a little bit of an edge in the direction of where you might want to trade. It doesn't by no means guarantee profits, because as we have down here, there is significant price action risk. You can look at, this is the price action for the last few months, and just since April, you've got a high to low range of 1,000 points. And so from April until now, if you were clipping 1.5 points every night for 60 days, 1.5 times 60, but you were on the wrong side of that 1,000-point move, it's not a successful strategy in that scenario there. So you definitely have to keep in mind that you are long this US dollar. You have a position in the underlying market, similar to people who trade options and are like, oh, I can see that like selling a put in the S&P 500, I get a positive theta, and so like every day that passes, I get this indicative, this theoretical value of maybe $1 or $2. But if the S&P is down 5%, that put is going to be trading against you if you're short it. Similar type scenario here, but maybe give us a little bit of context for what carry traders are looking for now that I've painted obviously the price action risk with a dollar yen, because that edge that I'm talking about, it's like the fact that a market is theoretically 50-50 on both sides. So what have you seen in your experience of people maybe holding positions like this for a short amount of time, medium, long amount of time? What are carry traders trying to do?
Yeah, so real theory-wise, it works the best when the market either doesn't move, it pretty much stays range bound, or it moves in your favor. So for dollar yen's sake, if we look before this year, maybe even before not last year, so would be a good example. So where dollar yen was basically just going up. It was going from left to right. I think we went from 22 to 24. We went from about, I think, 114 to 160 almost.
Crazy move.
Yeah. So that works. I mean, so the market's working in your favor, and you're getting paid to hold it overnight. So that's like your dream scenario as a carry trader. Now, the thing to keep in mind with carry trades is that when they unwind, and we've seen the yen carry trade unwind or try to unwind a couple times, things can get pretty ugly.
Yeah.
So you have to be mindful of that. Obviously, you still have to manage your risk. It's still a position. You still have a directional trade on in the market. 100%. So it's not like you're just there to collect the overnight. But I've seen people do it in euro for a long time, seen people do it in dollar yen for a long time. But you have to have the dynamics for it to work. It's not a foolproof strategy. There's no such thing as a free lunch for sure.
Yeah, like I say, if you had gotten long at 150 and you're taking a point every night, but then the market's against you, it's now trading 145, it's 500 points against you. And so to your point, there's a lot of people who maybe will look at it more long term and say, I think this dollar yen market is going to trade between 140 and 145, and so I'm long at, let's just split the difference, 142 half, and I'll take 250 points of risk to the downside because I'm going to hold this position for longer than a year and get my 250 points. Or, to your point, of course, we have no clue where the market is going, and it can always, if it's going in one direction, it can always get more painful. Contrarian traders might look at a market like this dollar Swiss franc and say, okay, I'm getting around a point every night in this overnight funding. U.S. rates are 4%, Swiss rates are near 0%. And the U.S. dollar, this kind of rarely happens, but it is a little bit of is it an unwind trade? It's a little bit of obviously the U.S. risk around trade wars type of scenario as well, where you have the U.S. dollar at historic lows and the carry trade positive in that U.S. dollar direction, which contrarians might look at as being very interesting of like, oh, I'm now long this market at the lows, I'm getting the positive carry. And to the flip side, trend followers might have looked at, that U.S. dollar yen rally a couple of years ago where it goes from 120 to 140 and be like, oh, I'm going to buy this on the rise to, 145, 150. And also I have that carry in my, working in my direction. Or to your point, again, I just think that this is a low volatile pair. I don't think it's going anywhere, and I'm just going to get that carry in my direction. Again, using the options analogy, Paul, Apple just fell 10%, and I'm a contrarian. I want to be long Apple, but what I'll do is I'll sell a put to get that theta in my direction. Or Tesla just ripped 20%. I want to be short Tesla. I'll sell a call to get that theta in my direction. Same thing with those trend followers. Oh, this market just ripped 20%. I'll sell a put now, positive theta, positive delta, and vice versa. Or again, I'll sell both sides of it. I don't think Apple or Tesla or any of these markets are going anywhere. Does that make sense?
Yeah, absolutely. And you can also get exotic with them. You could look at some different pairs. They have, you want to look at some, have some real flavor. I think I'm looking at a couple of these right now. Aussie yen looks interesting. It's whatever you're kind of interested in.
Doesn't have to be
Pounds,
dollar.
Swiss franc. Yeah, it doesn't have to be dollar. It can be some of these other pairs that have some more interesting, different interest rate differential dynamics. So, but this Swiss franc one's interesting. I mean, we're really testing lows that we haven't seen in a long time, and you're getting paid to hold that to be long.
Very interesting. Here is the interest rate landscape, and this is where we'll go out because this is really where the swap rates come from, right? And you can almost always look at those swap rates and look at the interest rates and understand, not necessarily, I don't even understand really the calculation. You understand the calculation. I don't understand the calculation fully. But this is where you get like, oh, that's why the dollar yen carry trade is so positive in the dollar direction, or even to your point, the pound yen or Aussie Swiss franc, whatever, because it's really just these interest rate differentials.
Yeah, absolutely. And I wouldn't tell people to go home and just do the math on the interest rates we have on the slides, and then
Doesn't matter.
It doesn't matter. The Tom Next rates are actually it's a tradable rate that you can trade with basically a liquidity provider, but there is a underlying Tom Next market that goes on that decides what it costs to borrow a currency overnight, and that's effectively what you see in the Tom Next rates on the platform.
There's math behind it. You can take a look at it. It's the same as options. Like, of course, if you want to read 3 books about the option Greeks, have at it. If you want to read about Tom Next rate, it seems wild, but I'm positive there are at least 3 books on Amazon on Tom Next rates that you could find. I wouldn't necessarily recommend it.